Hello. Welcome to Forex Central YouTube channel. Your way to financial freedom. For more information, make sure to check our other videos in this channel. Before you continue, make sure to like, press the subscribe button, and hit the notification bell icon to receive notification updates every time we upload new videos. Claim your Forex trading course tutorial videos for free. Just press like, subscribe, and hit the notification bell. To receive your free Forex courses, please send us your email address at forexcentralofficial@gmail.com with screenshot of your visit in our YouTube channel. We will send it through your email. Thank you. Now let's go for today's video. Forex Central gives special credit to Mohsen Hassan, CEO of MTG, for sharing his expertise and knowledge in Forex trading. Your dedication and commitment to educating others are truly appreciated. We are grateful for your contribution to this Forex Foundation training course.
In this section, we're going to be looking at technical indicators. So technical indicators are the biggest part of technical analysis. And the definition for technical indicators, taken from Wikipedia here, is technical indicators are a fundamental part of technical analysis and are typically plotted as a chart pattern to try to predict the market trend. Indicators generally overlay on price charts, price chart data to indicate where the price is going or whether the price is in an overbought condition or an oversold condition. So what this means is, so if I pull up a chart here of, I'm looking at Euro USD. If I want to look at a technical indicator is going to be something that's going to be plotted, overlaid on this chart. And this technical indicator, which there's different indicators, the way it's computed is going to be based on the prices that you see here and or the volume. Nothing else. It doesn't take any news, anything else. The only thing it uses to compute itself is this chart that you see here in front of you. Okay? Now, different indicators are going to use different things to compute themselves and different ranges. So if I'm looking here at Euro USD, I can go on the top here and click on indicators. When I click on indicators, I'm going to see that there's all of these indicators that I can use. So there's average true range, there's oscillator, there's Bollinger Bands, there's RSI, there's moving average, there's VWAPs, there's all of these indicators. Okay? And each of them is going to be computed in a different way, but all using the prices here and or the volume. So now we're going to look at different indicators. I'm going to look at the ones that I like the most for the Forex markets. Now, there's a lot of them. And it's not because there's a lot of them that you need to know all of them. A lot of them are useless and they're worthless, honestly. You can create your own indicator. A bunch of these indicators are just indicators that somebody just created, right? So you don't want to use too many of them. Okay, and the one thing to remember is that all these indicators, they only serve to highlight something that's already visible. Since these indicators are calculated based on the prices, then you don't really need to put them on. You can just look at the prices and that will tell you what the indicator would tell you. The only reason why we actually use them is it makes it easier for us. It highlights this thing that we might be looking for that without having the indicator on and just looking at the chart, we might not see. So it just serves as a highlight. Now, you don't want to use too many indicators. You want to find a few that you like and that work well for your type of trading and use those. And the reason for that is when you use too many things, you lose predictive value. You know, if you do any type of mathematics, you know that when you have a formula and there's several unknowns, like let's say y equals ax plus bz plus whatever variables, right? And you have many unknowns. If you try to add too many unknowns, you're going to lose predictive value. And they found in mathematics that if you use over more variables, more than 5 variables, you start predicting less efficiently than if you had less variables. For example, if I'm telling you, how can you predict if it's raining outside based on, you know, what your girlfriend, boyfriend is wearing? Well, you can type kind of predict, right? Because if she's wearing something like a raincoat, then it's probably raining. If she's wearing a skirt, then it's probably sunny. So, okay, that's good. Well, how could you predict the weather outside based on what she's eating? Well, I'm not too sure. How could you predict the weather outside based on her mood? Okay. How could you predict the weather outside based on the TV shows she's watching? How could you predict? If you start adding too many variables to try to predict this thing, you're not going to predict as well if you just took a few variables that have more value and just use these. And it's, I don't know if my example was good to get to what I want to say or the meaning, but a mistake that, new traders do is they try to use as many indicators as possible. And I look at their chart and they have so many indicators. They're just going to go in and they're going to just add everything. They're going to add everything and they're going to look at everything. And they're going to be like, oh, well, this says this and this says this. If I have 20 indicators and 15 of my 20 indicators tell me that, then it should go up. Not necessarily. No, because some of them are going to be conflicting. You're not looking at the same thing. So it's a mistake that all new traders do. Okay. And I'm here to tell you, don't do that. Take a few indicators and we're going to look at a few and you're going to see me use them and stick with those and you're going to have way better result than just throwing all the indicators out there. So without any further ado, let's jump into the first indicator and I'll see you guys in the next lecture. The first indicator we're going to look at is the simple moving average. What the simple moving average is an indicator which is basically just a line that we draw on top of the chart. And that line is basically computed using X amount of periods, averaged, and plotted on top of the chart. I'll show you exactly how it's done and what it's used for. So I'll grab an Excel sheet. Let's say we want to draw a 4-period moving average. A 4-period moving average. So basically we take 4 periods. Now it could be, by 4 periods, what I mean is candles. And when we talk about candles, we talk about the closing price of that candle. So if I'm taking, let's say, the last 4, if I'm looking at a daily chart, then I'm looking at the last 4 days. So I could have day 1 here, day 2, day 3, and day 4. Let's say on day 1, the closing price on that day was $10, right? The second day was 11. The third was, let's say, 12. And the fourth came back or continued going up to, let's say, 12 or 14. Okay, prices kept going up. Now, on the 5th day, what I'm going to do, this is the prices here. And I'll zoom in a bit here. You have the prices. Here I'm going to have the moving average. The simple moving average, and we'll call this 4 because it's 4 periods. So what I'm going to do here is I want to compute what is the average of these 4 previous days. Well, the average is going to be the first day plus the second day plus the third day plus the fourth day. This is the sum, so I have 47 divided by 4 because there's 4 of them. And this gives me the average of the last 4 days. And the average of the last 4 days is 11.75. Now, on the 5th day, maybe the price drops back to, I don't know, 9. Okay, price suddenly drops. Well, what is going to be the average on the 6th day of the last 4 days? Well, it's going to be this, right? It's going to be 11 plus 12 plus 14 plus 9. So we dropped the 10 because the 10th is 5 days before and I want to use the last 4 days and I add the 9. So I do the average of those and now the average is this. And maybe the price stays at 9 the next day. Well, on the 7th day, what is going to be the average of the last 4 days? Well, it's going to be 11 because I'm using these 4 prices. So I dropped the 11, I added another 9. So it's dropping a bit. So what the simple moving average does is it takes prices and it does an average of the last X periods. And what that does is it removes the noise. So if something is really moving wildly, you don't want to see all this noise. You want to have an average of these days to have a better idea of what's going on, right? So in this case, I would see that, okay, prices are starting to drop, okay? And it's more fluid. And I'll show you on a real chart here in a second. But these moving averages, you can have a 10-day moving average or a 10 period or a 20 period or a 50 period. It's really up to you. So if I grab back my chart here, and let me just remove some of these indicators that I've added in the last lecture. If I look at this chart, I can go here and I can go on indicator and you can look for it here. You can go to moving average, which is this one. There's a bunch of different averages. And there's exponential moving averages, which I'm not going to cover here because I've always just used simple moving averages. You can get the same thing from the simple one than the exponential one. So I don't really know a lot of people who use the exponential one. And the simple one just works pretty well. So you can Google the exponential one if you want, but for now, stick with the simple moving average. You can just write here MA for moving average, and you can find it. So all you have to do to add an indicator is just click on it. And here we go. We have this moving average now. You see, this line was not there before. And this line, I have a daily chart. The way it's calculated is basically like, let's say this point here, the way it was calculated is by using the last X periods to compute itself. Now, how many periods did they use? I can double click on it. They use the last 9 periods. So when you do a moving average indicator on TradingView, they default it to 9. So you can change it. Okay. So how many periods you want to use, I'll tell you in a second. But here, if let's say I put 4, then you would see that, let's say here, the way they drew this is by using the close of this one, 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 just sort of like we did. Now you'll see that if you have a very short period moving average, this line here is going to follow the prices very closely, right? If I have a longer period moving average, let's say 20, you're going to see that the line is going to lag a bit. The moving average isn't going to be as fast to catch on to the price. You see? Now it's more smooth. So if you want a smoother moving average, you put it longer term. It's going to be less impacted by the noise and by these candles. And it makes sense, right? If I'm using 4 periods and then the price jumps and I'm removing one candle and adding the new price of the other one new price entry over 4 has a lot of weight. So it impacts my moving average a lot. If I was using a 100 period moving average, I'm looking at the 100 periods. Well, if I'm dropping 1 day or 1 period and I'm adding a new one, even if this new one moved by a lot, it's only 1 out of 100 of data points. So it doesn't have a lot of impact on my moving average. So my moving average doesn't move as fast. It's very slow, right? So the longer term you're doing, the longer term moving average you want to look at because you don't want to get caught up with all these small movements, right? Now, the moving averages that I recommend is the 20 period moving average and the 50 period moving average, and that's for Forex. Now, if you're doing stocks or something else, you want to look at the 200-day moving average, you want to look at other things, but for Forex, which is what this course is about, I really like the 20-day moving average and the 50-day moving average. So this here is the 20-day moving average, and you can see that it shows you something. Well, what does it show you? The moving average, what it shows you is the direction. So it's a trend. So instead of just looking at the prices and being like, okay, it's going down, or you can look at the moving average, and the moving average gives you the average of the last 20 periods, in this case, because it's 20 period moving average, and you can see that the direction is downward. So it's downward sloping. So it gives you an indication of the trend. Now, if you use longer period moving averages, it could also be used as support and resistance. In Forex, I don't use it as much for that. I use it in a different way, which I'll be showing you in another lecture. But you can be using the 50-day and the 20-day moving average, play around with it, and it'll give you an indication of the direction we're going. Now, you could use it as resistance points, support points. You would need to use longer period moving averages. But yeah, you can use the moving averages on either daily charts like this or any type of charts. You can use 1-hour charts. You can use, let's say if I'm going here, I can put 1-hour charts. And you'll have the moving averages as well. You can do 15-minute charts. Whatever time frame you're looking at, it'll use the X amount of candles. So if I'm using a 1-hour chart and I'm using a 20 period moving average, I'll be looking at the last 20 times 1 hour, so last 20 hours to draw it. Okay. So this is going to be the simple moving average. And what we'll do in the next lecture is actually add on top of the moving averages to see how we can use them to find entry and exit points. In this lecture, we're going to be looking at moving average crossovers. So moving average crossovers, what are they? The way it works is you draw 2 different moving averages on top of a chart. For example, let's say I look at this currency here. I'll go on, and it doesn't matter what time frame you're looking at. Again, the time frame depends on how long-term or short-term you want to be trading. If I'm looking at a 4-hour chart here of New Zealand dollar to US, and I add an indicator, moving average, I'll plot it here, and let's add a 20 period moving average. So I'll change this to 20. And you see, 20. Okay. Then I'm going to add another one. I'm going to add another one, and I'm going to have the 20 period, which is the one I'm going to call my short-term moving average. And I'm going to add one that's longer term. Okay. That's slower to react to recent price changes. Now, the second one here that I just added, I'm going to change it from 9 to 50. So I'll have a 20 period moving average and a 50 period moving average. And look at this. The 50 period moving average is slower to react than the 20-day moving average, right? Makes sense. 50-day, more data points. Each data point has less value. So a new day, a new move impacts it less than the 20-day moving average. And what this tells me is that if I use moving average as an indicator of the direction we're going, as a trend, well, what if I have one that's shorter in term? So a 20-day one versus a 50-day one. The 20-day moving average is going to tell me about the direction in the short term versus the 50-day moving average, which is going to tell me the direction in a longer term. And what I can do is I can look at these two different moving averages and see if one changes versus the other. For example, if my 50-day moving average is going down and my 20-day moving average is going down faster, what that tells me is the last 20 days were worse than the last 50 days because the 20-day moving average is lower than the 50-day moving average, right? But then if at one point the 20-day moving average goes above the 50-day moving average, so it crosses over the 50-day moving average, what that tells me is in the last 20 days, prices were better than in the last 50 days. So we might be reverting. So we've been going in a direction, but recently we're starting to go in a different direction because the shorter term period moving average crossed the longer term moving average. We'll look at it here. So let's say here, for example, okay, we're starting off and we have the short-term moving average, the 20 period, crosses below the long-term moving average, which tells me in the last 20 days, and if I look at the last 20 days, this, the prices are lower than in the last 50 days, okay? And because the last 20 days has this really big, there's these few bad prices, and these few bad prices really impact the last 20 days more than they impact the last 50 days. So that would tell me that I need to short, okay? So at this point here, I need to short, which the prices, I'll be shorting at this price because here is what the price is. But this is the indicator. And since the shorter term moving average crossed below the longer term moving average, I want to short. So I'll be shorting somewhere here, okay? Now, as long as the shorter term moving average is lower than the longer term moving average, I know that, in the short term, prices are going in that direction compared to the long term. So I would stay in that position until we get to here. And I'll be closing my trade here. So I would have made some profit, okay? Now, at this point, we'll zoom in. The shorter term moving average goes above the longer term moving average, which tells me that now prices in the short term in the last 20 days are a bit higher than in the longer term, right? Because in this short term here, I have these days that have a bigger impact than on the last 50 days. So here I might have went long. I would have bought. This would have been a bad trade because I would have bought, but then right away, the 20-day moving average would have crossed below again because of this huge red candle, and I would have taken a loss. But that's okay. One good trade, one losing trade, which is smaller. Now we crossed the shorter term moving average, crossed below the longer term moving average again. That would have been another sell indicator, another short. I would have shorted here. Then prices went down and again recrossed over here. So I would have closed my position at this point, another winning trade. And again here, there's a whipsaw. I would have went long. I would have lost on this trade, but barely. I would have bought here and sold here. Barely a loss. But here I would have shorted again because the shorter term moving average crossed below the longer term moving average. and I would have still had this trade open until today, which is pretty good because it's really deep in the money now, right? So this is how you would use it. It really tells you when there's a change in direction, okay? Because you have two different moving average, one short, one long, and the short really tells you what's going on more recently, the long, what's going on more not so recently. And when the recently moving average crosses below the not so recently moving average, it tells you that there's a shift or we might change. So you can use that to enter and exit positions. And that's where some of the indicators that you hear people talking about, like MACD, moving average convergence divergence, all of these other indicators, they're just based on that. So all you need to do is just use that, because that's what they do. They take moving averages and they see how much they diverge or they reconverge, and they try and do these things. Well, here you go. You can just look at it like this. And when there's the crossover, you know that there's a shift, right? And you can look at this in different places. Like let's say on this one, you can see that we crossed over. Well, we crossed over here. So you would have been in a long position and you would have stayed in this long. And you see the shorter term moving average. So the last 20 days here, right? Starting to slow down. Okay. And it's because these new days that are lower, the last 20 days are about to be less than the last 50 days. So we're about to cross below, and this would be a sell indicator. So we get out of it. We get out of our long position. So we take our profit on it and we even go short. And, you know, it's whenever you start trading and you learn about moving averages, it's the easiest way to get rolling, you know, and just to practice. Obviously, when you're practicing, you practice with fake money. So it's not a bad idea to just play around with it, because it's such a simple way to trade and to get experience in sending orders, seeing your positions, doing all of these things that you want to learn about. It's a nice way to learn about them, because it's just a simple way of doing things. And you might like trading with moving averages, and this could be your way of trading, or you could trade with something else, but it's a good way to get practice. So, you know, add some moving averages to your charts, see if you can see a crossover where you would want to enter a position or not. Anyways, we're going to be looking at entering positions and all that stuff at the end of the course. But start looking at your charts to see if you can see some crossovers. And that's really what crossovers are. You can play around with the time frames for your moving averages. You can try two shorter ones, two longer term ones. You can try different time frames on your charts. Play around with it. And yeah, that's it for moving average crossovers. The indicator we're going to look at in this lecture is called Bollinger Bands. So Bollinger Bands is one of my favorite indicators to use. I use it in stocks, in Forex, in cryptocurrencies, and it makes a lot of sense to use. And it's very intuitive. And, you know, you wouldn't, even if it didn't exist, I would have used it by looking at the chart, but it just makes it so much simpler. It really highlights what I want to look at. So what is Bollinger Bands? We can go on indicators here, you can write Bollinger Bands, or you can just write BB. It knows it's Bollinger Bands, and it's the basic Bollinger Bands that we're going to be using. And what Bollinger Bands is basically, and I'll go here on this chart, is basically a moving average that's drawn in the middle, and here you can double click on it. It's a moving average that's based on the last 20 periods. Okay, so it's a 20 period moving average, and there's a upper band that's drawn above this moving average and a lower band that's drawn below it. Now, how is it drawn and how is it used? Very simple. Now, the way it's drawn is basically they're using what we call a bell curve. So in mathematics, you have what we call a bell curve. And a bell curve here is used to measure distributions around a variable. And this could be anything. It could be, I don't know, grades in your class. It could be height of men. It could be prices of houses. It could be whatever, okay? You can use the normal distribution to draw these entry points. So example, I could say that the average height of a man is 1.7 meters, okay? And then I could try and see, well, what is the probability that a man is 1.5 meters or 1.4 meters. What is the probability that a man, or how much of the population is above 2 meters, right? And it would be like this part here. Now, what we want to do is use the bell curve or use this normal distribution, but for prices, okay? The way the bell curve is drawn is it uses what we call a standard deviation. And the way we use it is we take all these data points and we say, okay, well, what if we want 66% of the population, okay, to be within one standard deviation of the mean? Well, then what is a standard deviation? So example, if I say I want to know between which range are going to be 66% of the population between this height. And then I'll figure out what a standard deviation is. And maybe I'll find that, one standard deviation is going to be equal to 10 centimeters. So then I know that there's 66% of the population between 1.8 meters and 1.6 meters, right? Because I know that in a normal distribution, there should be about 66% of the variables within one standard deviation. And you can actually just Google it. I'll Google it real quick. Bell curve standard deviation. So there should be between two standard deviations, 96% of the population, and then between three standard deviations, 99% of the population. So let me find a good one here. Okay, so between one standard deviation, you have 98%, two standard deviation, you have 95%, and three standard deviation, you're going to have 99% of the population. Okay, here you have it here, right? 68, 95, and 99. So what we're doing, without getting into the math and calculating standard deviation, because you can go look at it, but I want to keep this as concise as possible. We're, instead of using it on men heights or anything like that, we're using prices. So we're looking at the last 20 periods. We're looking at the prices. And based on the volatility, the more something is volatile, so let's say if men heights were very volatile, some men were really tall, some were very small, then one standard deviation would be maybe 20 centimeters, right? So to have 66% of the population within that range, it would have taken a bigger range, right? So the more volatile something is, the bigger the standard deviation is. So what we want to do is look at prices. We're looking at the last 20 periods of prices. We're looking at how volatile they are, and we're deciding on what a standard, the math decides on what a standard deviation is. And then what we do is we draw a bell curve around the price. So imagine this. Imagine I have my chart here, and I have prices who fluctuate. What I'm doing is, based on these prices, I'm drawing a bell curve. And I'm saying, you know what? This is the prices and this is how they act. The price acts. What is the probability that the price stays within two standard deviations? Well, I know that there's 95% chance that it stays within two standard deviations. Okay. So now I can say, well, I'm very confident that the price is going to be within there. So I'm going to draw a lower band at this two standard deviation here, and a higher band at two standard deviations above. And then I can be confident that the price of this currency is going to stay within those standard deviations, because it's very unlikely that it goes outside of it. It's only 5% chance that it goes outside of it. Or I could say I want to draw bands at three standard deviations. So it's 99% chance that the price stays within those bands, right? So this is what's done here. When you're drawing this, we are drawing a moving average with a lower band at two standard deviations below the moving average and two standard deviations above. So we have a 95% confidence that the price will stay within those bands. And if I double click here, you see that it's using a standard deviation of 2. Now, if I want to be more confident and I want to widen my bands, I want to take the extremes out of this bell curve. I want to be 99.7% sure that prices will remain within this range. I can increase it and put a 3 standard deviation. And you'll see that my bands are going to widen, right? And now my bands are bigger, okay? The way you would use the bands is be like, okay, well, you know what? If prices drop, it's very unlikely that it keeps dropping because, it's already so far out. So I'm going to buy when it touches the lower band. And then when it comes back, I'm going to get out here. I'm going to take my money. And here I'm going to buy again because it touched the lower band. And here when it touches the middle band, I'm going to get out. And here again, it barely touched them. So here I would have shorted and here I would have gotten out. So these are all profitable trades. But you could have used a 2 standard deviation and gotten way many trades. But again, you would have gotten them early, but you would have gotten a lot more trades here. So, if you're more aggressive and you want to get more trades, you use tighter bands. If you want to take very fewer trades, you use wider bands and get those trades that are at extremities. Now, when do you use a Bollinger Band as an indicator? You're just not going to use it all the time. A Bollinger Band really looks at deviations from the mean. So you want to use it in a mean reverting strategy. That means when you're trading something that you believe is going to mean revert, meaning that when it goes up, it's more likely to come back down, and when it goes down, it's more likely to come back up. Not in something that's trending or that could go in a momentum in a direction. You don't want that. So I would like to use something like Bollinger Bands between currencies that are very similar. Example, Canadian and Australian dollar, which have very similar economies that move in similar fashions. So when they deviate from each other, they reconverge, and when they converge too much, they redeviate. So to trade this currency pair using an indicator like Bollinger Bands makes a lot of sense, because when they deviate from each other, they reconverge back. When they converge too much, they redeviate back. So you can use this to see how far have they deviated from each other, and at that point, get into a trade. And you'll see in something like this, even I'm looking at this currency here, you can see that here you would have gotten a lot of good trades. You would have been able to buy the lower bands, get out in the middle, short at the higher bands, get out in the middle, buy the lower bands, get out in the middle. Here, short, get out, buy, get out, short, get out, buy, get out, short, get out. Here you would have shorted, and when you would have gotten out, you would have lost money. So here's a losing trade, but all of these were winning trades. And here, all of these are winning trades. So one losing trade and all of the others were winning. So very good indicator for this currency at this particular time. Now, one thing you want to watch out for is that in the financial industry, the bell curve is not a regular bell curve. So usually the bell curve, regardless of the industry, looks very similar. But in the financial industry, what we have is what we actually call a fat tail curve. So instead of having a regular bell curve like this, what we have is a fat-tailed curve where it looks more like this. Well, sorry for my drawing. Wow, this is so bad. Let me just redraw this. Might be even worse. Okay, so basically, things that usually happen here in the middle, they're more likely to happen, and things that are very unlikely usually, things that usually in a regular bell curve are very unlikely, are more likely in the financial industry. So this is why we don't really call them bell curves in the financial industry. We call them fat-tailed bell curves, because things that are very unlikely tend to happen way, way, way more often in the financial industry, in trading. Things that you would think would never happen, they seem to happen all the time. So just understand that it's not because you're at 3 standard deviations or 4 standard deviations that the price will never go there. Prices will go there often. So you just want to be careful in your position sizing and all of that, because prices can go to those extremes very often. So this is what Bollinger Bands are. So what I would challenge you to do is look at your charts again, see if you can find a currency where Bollinger Bands look to work pretty well on, and see if there's a reason for that. See if those currencies are actually or have similar economies, and you would want to use this indicator to trade them or not. In this lecture, what we're going to look at is the RSI, short for Relative Strength Index. Now, what the Relative Strength Index is is basically an indicator that's drawn at the bottom of your chart. You'll see it at the bottom of your chart that tells you something about if this product that you're trading is overbought or oversold. Now, the way that it's calculated is it takes a look at the last 14 candles. Okay, it takes the last 14 candles and it takes a look at the size of the green candles versus the size of the red candles. Now, if the green candles are way bigger than the red candles, so if the green candles are bigger than the red candles, then the RSI is going to give you a big value. So the RSI, the values that it can range between are between 0 and 100. So if the green candles are way bigger than the red candles, it'll be closer to 100. Now, if the red candles are way bigger than the green candles, then the RSI's value will be closer to 0. Okay? Usually, around the RSI line that you see here, we are going to draw a line at the bottom and a line at the top. Now, you can decide at which location you want to draw these lines, but usually they are drawn at the 30 level and at the 70 level. And that's the default, and that's what everybody uses. Some people are more aggressive, they use 20 and 80, but usually it's 30 and 70. So what we say is, if the value is below 30, we say that the product that you're trading is oversold. Why? Because the red candles are way bigger than the green candles. So it's oversold. Now, do you want to buy something that's oversold? Well, what do you think? If the RSI's value is above 70, we say it's overbought. Why? Because the green candles are way bigger than the red candles. Okay? So it's overbought. People are buying it more and more aggressively, right? That's why the green candles are way bigger, because the buyers are buying it so more aggressively. We say it's overbought. Do you want to short something that's overbought? Now, the reason why you don't just want to short something that's overbought or buy something that's oversold is things can remain overbought or oversold for a very long time. Imagine this. Imagine there's something that's dropping. Red candles are way bigger than green candles. So it's oversold. And you see it's oversold. Then you're like, you know what? I want to buy it because it's oversold. It's going to come back up because sellers are selling it more and more aggressively. Red candles are way bigger. And you buy it. And then guess what happens the next few days? Red candles keeps getting bigger and bigger than the previous red candles. And the green candles keep getting even smaller. So then it's even more oversold. So things can remain oversold for a very long time. If you're looking at stocks, some stocks go down to 0. So people can, and even when you're looking at currencies can fluctuate a lot. So things can remain oversold or overbought for a long, long time. So you don't want to just buy something that's oversold, and you don't want to short something that's overbought. What you want to do is wait for it to stop being oversold or overbought and then get into a position. For example, if you look here, prices, red candles are getting bigger compared to the green candles. And you see here it becomes oversold. Now, I don't want to buy as soon as it became oversold. I want to wait until it stops being oversold and the RSI line crosses over above the oversold line, because you see here green candles started being bigger than the red candles and it's not oversold anymore. So then I would buy the position. And then as it goes up, here it became overbought. I don't want to short right away, but when it stops being overbought, again, because of this red candle, that's way bigger than the green candles, then I want to get into my short position. And again, here, it would have been a profitable trade. Again, oversold, I don't buy right away. I wait until it stops being oversold and then I buy, right? So if I'm looking at a currency here and I want to look at the RSI, all I have to do is go in indicators, type RSI. The first one it shows up, Relative Strength Index, click on it, and you see the RSI at the bottom here, okay? So let's say if I'm looking at the price here right now, well, imagine this. Imagine I want to buy this currency, or imagine I want to short it, sorry. Imagine I want to short it. Well, would I short it right away? Not necessarily, right? Because it's trending up. And then look at this. Here it becomes overbought, because the green candles are way bigger now. You can see them. So it's overbought. Well, am I going to short right away? No, not necessarily right away. I want to wait until it stops being overbought. Okay? So there's the potential for reversal. Okay? And this is what this indicator is going to help me with. And I see here that red candles became bigger all of a sudden, and green candles became a bit smaller. So then it stopped being overbought. So this would tell me that, you know what, at this point here, that it stopped being overbought is a good place to short. Okay? And then, guess what? Well, that was a good place to short. So it helped me in not shorting too early, right? And this could have been done the other way around. Prices could have been dropping, and if I wanted to buy this product, well, or let's say here, right? Let's say while it was dropping, I wanted to buy. Well, when do I buy? And there's this big red candle. Do I just buy here? No, because this could have continued dropping, right? But then when I see that, okay, the green candles came back bigger and the red candles became smaller again, we're not over sold anymore. We were, but we're not. Then there's a potential for reversal. Then I would get in here. And again, that would have been a really good trade. So you can use it in both sides. It's used for reversals. And you want to always not buy as it's overbought or oversold. But when it becomes that and then stops being that, that's when you enter a position. So my challenge to you is look at your charts, put the RSI indicator on, see if you can find some places where there is a reversal that happens and you could have spotted it through the RSI. Again, with all these indicators, the more you use them, the more you play with them, the better you'll get at spotting when to use them and when not to use them and how to use them, and you'll get better at using them as well. So that being said, that's the RSI, and I'll see you guys in the next lecture. In this lecture, we're going to be talking about the Fibonacci retracement indicator. So this indicator is based off the Fibonacci sequence or the Fibonacci ratios developed by Leonardo Fibonacci, who's an Italian mathematician. And all of this is going to be based off the Fibonacci sequence. And the sequence is basically a series of numbers. And each number in the series is the addition of the previous two numbers. For example, you have 0, 1, and then the next number is going to be 0 plus 1, which gives you 1. The next one is going to be the addition of the previous two numbers. So 1 plus 1, which gives you the 2. Then here we have 2 plus 1 gives you 3. 3 plus 2 gives you 5. 5 plus 3 gives you 8. 8 plus 5 gives you 13. So each number that you have is just the addition of the previous two numbers. And this keeps going on forever, right? So I can just open a Google tab here, and we can just write Fibonacci sequence. And you'll see here that the sequence keeps going, right? Now, one really nice thing that we get out of the sequence is some ratios. And the ratios that you can get are basically when you divide one of the numbers by the next number. Okay, so I'll pull up a calculator here, and I'll go 610 divided by 987. It gives me 0.618. Okay, if I take any other numbers, like let's say 6, I'll take this one here, 6765 divided by the next one, 10946, I'll get again 0.618. So whichever two numbers I divide like that will give me the same ratio. And you can look into the Fibonacci sequence. There's a bunch, and this is one of the reasons why it's used in trading, because it's something that you can see throughout nature and throughout architecture, throughout beauty. You can see it in the face of people that we find beautiful, ratios between different aspects of their faces. You can find it in nature, you can find it in the pyramids, you can find it everywhere. And this is why it's very well known. You've probably heard of it before. Either you've heard of Fibonacci sequence, or you've heard of the golden ratio, which is based off of that, or phi, or any of these things that relate to the Fibonacci sequence. So you can actually watch documentaries about that. Anyways, now how do we use these ratios in trading? So there's an indicator that we can use here, and I'll pull a chart here, that's called the Fibonacci retracement levels. So when you open TradingView, you can go here, and then you have a bunch of different indicators that you can use. One of them is called Fibonacci retracement. And you'll see that there's a lot of other indicators based on the Fibonacci here. Fibonacci channels, wedge, and you can look into those, but the one I prefer is the Fibonacci retracement. And the way it works is once you select it, you have to select a true and a peak. So you select here the lowest point that you see and the highest point. Now, once you select the highest point, you can just extend this further so you can include the rest of the chart that you want to see. And basically, what's going to be drawn here is some of these Fibonacci ratios. So you see here, we went from 1 to 0, or 0 to 1, it doesn't really matter. And you have levels at the 23.23, so the 23% from this level here, 38% from this level, 50%, 61.8, and 78.9. So you remember here the ratio we just calculated? 61.8. That's the level here, right? Now, how do we get these other levels? Well, take a look at this. If I take, let's say, 610, instead of dividing by the next one, I'm going to divide by the next one after that. So divided by 1597, what am I going to get? 38.1. And this is the level here, 38, right? And if I go another one further, so let's say I go 610 divided by, not this one, but this one, 2584. And I could have chosen any numbers and divided it by the 2 after that. It'll give me the same thing. I'll get the 23.6 level here. Now, one of these levels here on the Fibonacci retracement isn't actually a Fibonacci level, and this is the 50 one, the midpoint one. This is just added because a lot of times you'll see that retracement does happen to this level, so it's been added there. But it's not an actual Fibonacci ratio. And you can actually play around with this. There's some really nice mathematical properties. Let's say if you go 610 divided by 1597, and we get back the 0.381, which again is this one here, right? Well, look at this. If I do the square root of this number, guess what I'm going to get? So square root, I'm going to get 618. So I'll get this one here. Now, if I do the square root of that one, 78.6, which is this one here. Right? So there's some very nice mathematical properties with this sequence here. And the way it's used basically for this indicator is once you draw the true to the peak, you're looking at something that's going in one direction and you believe it's going to keep going in that direction. But it's a natural and healthy thing for things to pull back or retrace before continuing in that direction, right? Now, the thing is, how far are they going to retrace? And what we found is, or what has been found, because I didn't do the research, just what has been found, is that retracement tends to happen to levels that are computed through the Fibonacci sequence. So it's more probable for retracements to happen to some of these levels, like the 0.38 or the 61% level or the 78% level. So because of that, when you draw this indicator, you get all these levels there. So you know that there is a high probability that we pull back to one or several of these levels. So if you're planning on, or if you think that this position or this currency is going to continue in that direction, but you don't just want to buy right away, you want to wait for a retracement, you can place your orders at those key levels because you expect it to bounce back off of one of these levels and then continue. So one of the ways you would be trading something like that, if you want to go long, in this case, USD CAD, and you just don't want to buy at any level, and you expect the trend to continue, well, you can place your order at, and you can split your orders. One of the ways I like to trade is split my orders in 3, put quarter of it somewhere, another quarter somewhere else, and then half of it somewhere else. So I do pyramid position sizing, which we'll look at later when we talk about position sizing and how much to buy and where to buy. But basically, you can place part of your order here. So you can buy 25% of your position here. And then if the position keeps going against you, you know that at the 50% level, there's high likelihood that it goes back up. So you put another quarter of it here. Once it goes back up, you can sell that quarter that you bought here at a profit while keeping the previous quarter that you bought here longer. It falls back. You can buy again that quarter here. It falls to this level, the 61 level, then you can buy the remaining half here. And as it goes up, you can sell that half here. Goes up, you can sell the position you bought here over here. Goes back down, you can buy again. So you're trading this range here, right? Comes back down, you can rebuy the position that you had bought here previously. Goes back up, you sell it, goes back up. The position that you bought here, you might have sold here, unless you wanted to keep it for longer. So you can really trade those ranges and have, specific entries in the same way we use all technical analysis, just for finding entry zones and exit zones and being able to get in, get out, get in, get out, and, go back on another currency and do trades with your funds while not using them in this position, instead of just buying and holding it and, just holding long term and going through all these movements without capitalizing on those movements. So this is the Fibonacci retracement indicator. It's based off the Fibonacci ratios, based off the Fibonacci sequence. And, you can use it when you're looking at something that's going in a specific direction. You're expecting a retracement and you want to find optimal entry zones based on the Fibonacci ratios to get in and get out of your position.